How do open market operations affect interest rates? Have you ever wondered how the actions of the Federal Reserve can impact the interest rates you see every day? Open market operations are a key part of this process. These operations involve the buying and selling of government securities by the Federal Reserve in the open market. This is one of the main tools the Federal Reserve uses to implement monetary policy and manage the economy. When the Federal Reserve buys government securities, it pays banks for these assets. This payment increases the amount of money that banks have available, which is known as reserves. With more reserves, banks are able to lend more money to businesses and individuals. This increase in the money supply usually leads to lower interest rates. When borrowing becomes cheaper, it encourages people and businesses to take out loans, which can boost economic activity. On the flip side, when the Federal Reserve sells government securities, it pulls money out of the banking system. This means banks have less money to lend, which reduces the overall supply of available funds. As a result, interest rates tend to rise. Higher interest rates make borrowing more expensive, which can slow down economic growth. The Federal Reserve aims to target the federal funds rate, which is the interest rate that banks charge each other for overnight loans of reserves. By adjusting this rate, the Federal Reserve can influence other short-term and long-term interest rates across the economy. From a conservative viewpoint, open market operations are seen as a way for the Federal Reserve to manage the economy without directly intervening in private markets. Supporters argue that this approach allows the market to operate more freely, with the Federal Reserve acting as a stabilizing force. However, some conservatives worry that relying too heavily on these operations, especially large-scale purchases of securities, could distort market signals. This might lead to issues like inflation or asset bubbles. Open market operations are conducted by the Federal Reserve Bank of New York, following guidance from the Federal Open Market Committee. These operations can be either permanent, involving outright purchases or sales of securities, or temporary, involving agreements to buy or sell securities with a promise to reverse the transaction later. The ability to adjust interest rates through open market operations gives the Federal Reserve a powerful tool to respond to changing economic conditions. When the economy is sluggish, the Federal Reserve can lower interest rates to stimulate growth. Conversely, if inflation becomes a concern, the Federal Reserve can raise rates to cool things down. This flexibility is generally supported by those who favor limited government intervention, but it also raises questions about the appropriate scope of central bank power. In summary, open market operations play a vital role in how the Federal Reserve influences interest rates and the economy. Understanding these operations helps clarify how monetary policy can affect everyday financial decisions.